Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is one of the top experts on the oil and natural gas markets. He is the chief investment officer of a oil and natural gas hedge fund that buys publicly traded companies in the oil and natural gas markets in the US and Canada of Bison Interest. Josh Young, thank you for joining me again.
Great, Jason. Thanks for having me.
And Josh, Happy New Year. And Happy New Year to our listeners out there. We're recording this interview on Friday, January 10th, 2025. The West Texas Intermediate oil price looks like the oil markets are starting to put in a nice bottom here, Josh. Starting to see some positive price action finally for different oil prices. The West Texas Intermediate crude price, what it was in a trading range for the last, six to 8 months. Looks like it's finally well above $70 here when we're recording this interview at over $76 right now. I want to get your thoughts on the supply and demand of the oil market because there's a lot of oil bears out there saying that the only reason the oil price did not crash further was because the Saudis were cutting the market. What are your views on the current supply and demand situation in the oil market?
Yeah, it's funny. A month or so ago, I participated in a bull bear debate on the oil market, and the folks that organized it have a huge following, and they told me they couldn't find anyone else besides me in sort of the fund manager research analyst community to represent the bull side of the oil market. And this was with oil at about $68 a barrel. So yeah, it's pretty bleak out there from a sentiment perspective still. It's one of those really strange things where I think the consensus for 2024 was really bearish, and from a supply perspective and demand perspective, and I think there was this expectation that there was going to be roughly a 1 million barrel a day build in inventories. That was the EIA forecast and the IEA. I think one of them might have actually been closer to 1.5 million barrel a day forecast. Anyway, we ended up with, it looks like 300,000 barrels a day or so of declines in global inventories, not that million plus barrel a day of builds. So that was last year. This year, the same folks that were projecting builds last year are also projecting builds this year. So we're just sort of climbing this wall of worry, but we haven't really seen the price move up despite inventories continuing to surprise to the downside, which should lead to much higher oil prices.
It's just really weird, Josh. Like, I won't name names, but it seems a lot of the oil experts that go on business television and the major like macro podcasts, I've listened to their interviews, they're never bullish oil. And then they talk about like ESG and climate change and all the other forms of energy, and they're never bullish oil. And then they talk about how if the Saudis weren't cutting oil production, that the oil price would just collapse. It's just a weird market, but the companies allocating capital, Josh, so like your Exxon Mobil's, your ConocoPhillips, they're aggressively going out and doing deals the last 2 years. There's around $250 billion worth of mergers and acquisitions in just the last 2 years.
Yeah, there have been a huge number, well, a large number of deals, but also a few really, really large deals. And it is funny, like you say. I mean, some of these folks, it's great for selling subscriptions. Some of the leading sort of finance, subscription services and research services and stuff were all sort of very, very bearish oil. And again, it hasn't been super fun or profitable to own oil stocks the last couple of years, but the price hasn't collapsed, and there hasn't been this sort of calamitous move to 50 or 40 or wherever it is that people have been sort of forecasting. And yeah, OPEC has been supportive of the oil market, but even if you didn't have this sort of extra support from Saudi, you would have had inventories roughly flat last year, rather than and potentially flat so far this year. I know we're early in the year, but it looks like we're at sort of a pretty rapid pace of inventory declines. So I don't know where people were sort of seeing that they were going to get all this oil from, or why there was so much bearishness. And there is one really positive fundamental aspect to all this, which is, as you have these deals and as you have the capital budgets coming out, you have budgets based on oil at 70 and sort of the forward curve actually even lower. And so you're having less and less drilling activity and less completion activity which is going to lead to even less supply. And then on the demand side, you have more and more consumption, or at least you have less sort of consumption degradation, because any sort of incentive to go shift from oil to renewables or oil to electric vehicles on the transportation side of oil consumption gets reduced when it costs less than 250 a gallon for gasoline here in Houston. So why would you go buy an electric vehicle? Electric prices, power prices are the highest they've been maybe ever here. But gasoline prices certainly aren't. So, it's a very interesting dynamic. And I think the longer people are bearish, the more bullish I am, and maybe the more bullish everyone should be, because there's actually a real world consequence from that bearishness in terms of lower supply and actually higher demand.
Well, in terms of the valuations in the S&P 500, I think the oil and natural gas companies, for the earnings per share, the free cash flow, and the profits, don't they have some of the cheapest valuations of any sector out there?
Yeah, definitely. It's one of those big disconnects. And, when you point it out, especially these days, you'll hear people say, oh, well, that just means that, if energy companies are, let's say, 10 or 13% of the earnings for the S&P 500, but they're only 3% of the market cap, that just means their earnings are going to come down a lot. That's what you'll hear from most people. But historically, that's not really been how this sort of gap has been realized. And getting back to the merger and acquisition activity, when you listen to the CEOs of these companies making tens of billions of dollars of acquisitions, they're talking about seeing a shortage of drilling inventory and a potential supply shortage of oil in the next few years. And so that's their rationale for going and doing these multi-billion dollar or deca-billion dollar deals that are not cheap. The valuations are pretty high and require $80+ oil in some cases to get to a reasonable break even over potentially 5 to 10 years, depending on the deal. So the people that are spending the most money on these assets at some of the largest oil and gas companies in the world, with some of the backing of some of the most famous and successful investors in the world, are seeing a high likelihood of much higher prices in the next few years.
And I think we're going to see a lot more energy demand growth, but maybe that's from liquefied natural gas, as these data centers, they just keep getting bigger and bigger for artificial intelligence. And then this next technology cycle, we were talking about this before we started recording over the last week. We'll talk about that in a little bit with the new Secretary of Energy that Trump appointed, how some of the policies are going to be pro natural gas, pro liquefied natural gas exports. But I wanted to ask you about oil production growth. Are we only seeing oil production growth, Josh, out of the Permian Basin? Are there any other areas where there's sizable oil production growth?
Well, I actually don't think we are seeing oil production growth in the Permian anymore. At the current rig count, it looks like we're at just over 500 rigs in the U.S., which would mean close to 400 rigs for oil. I'd have to double check the very latest number, but it's around there. At that rig count, with most of those rigs in the Permian, especially on the oil side, you're not really seeing crude oil production growing at all. And so when you look at where oil production grew in 2024, you saw production grow in Canada, you saw it grow in Guyana, and you saw it grow in one or two other jurisdictions, and that's it. And so there was supposed to be all this growth in various other non-OPEC countries. There was supposed to be production growth in OPEC countries as OPEC production cuts were supposed to unwind. And there was supposedly, like you were mentioning repeatedly, supposed to be this OPEC cohesion issue, and it was all over various major publications and media outlets and so on. And none of that happened. I think the biggest single miss was probably U.S. shale, and then the next biggest miss was Brazil, where there were supposed to be hundreds of thousands of barrels a day of production growth. And I saw the official numbers for November. It looked like Brazil's oil production was down 10% year over year instead of what was supposed to be up 5 to 10% year over year for last year. So really big misses. And so, I think it'll be a really interesting question. What happens this year as the rig count stays low, or if the rig count stays low, what happens to U.S. Shale production, which is very high decline and requires a lot of activities to sustain production levels, and then where supplies come from to meet continuing growing global oil demand.
Do you think the lack of oil production growth in 2024 was it because the Federal Reserve Bank they didn't start cutting interest rates till towards the later in the year, and then the cost of capital for a lot of these private shale drilling companies they were trying to sell the company, so they didn't want to necessarily keep on borrowing debt to grow for growth's sake. They were trying to put the company up for sale and sell it to a publicly traded oil and natural gas company. So with cost of capital, and then the oil price was in a range, so it was maybe below break even for some of these wells in the Permian.
It's complicated. I'm not sure that interest rates at current levels or the levels they were at last year really played too much of a role. I think there was significant inventory depletion as you look at some of the fastest growing producers on the oil and actually on the natural gas side. You saw them start to show signs of significant inventory depletion. And to be clear, I'm not saying that overall shale inventory has fully depleted, but individual operators are showing signs of that. That's actually part of why we got pretty bullish on natural gas recently, is seeing some of these signs of inventory depletion. And so I think some of the slow in growth and some of the actually declines in production by individual operators, particularly on the private side, is reflective of depleting their core inventory and sometimes depleting their tier one. So, depleting the inventory that would break even below $50 oil. And then in some cases, depleting their inventory that would break even below $60 oil, let's say, assuming $2.50 or $3 natural gas. And so as those companies hit those levels, they weren't able to deploy incremental capital that would be accretive using private equity supplied capital requiring 20% plus risk adjusted rates of return. And so I think that's actually probably the biggest single factor. And then the complementary factor to that is that a number of the fastest growing companies that had substantial remaining inventory, both on the oil and gas side, have been acquired or merged into larger publicly traded producers. And a number of those producers on the oil side and several of those producers on the gas side have shown real capital discipline and a real focus on maximizing their corporate returns and their shareholder returns. And so those, I would call them sort of good actors, very shareholder focused, very return focused. Those companies, I think, have actually turned the tide, at least in the US, both on the oil side as well as increasingly on the natural gas side.
So if I could summarize what you just said over the last couple of minutes, you think that these acquisitions, mergers and acquisitions, they're going to drastically slow down the production growth because they're going to be focusing on free cash flow. If their share price is cheap or their valuation is cheap, they'll do share buybacks. They're going to focus on paying out a percentage dividend rather than a fixed dividend, depending upon the amount of free cash flow. And they're trying to manage their inventory levels with the acquisitions.
Yeah, but here's the powerful part of that. This isn't a forecast. This is a description of activity over the last year and a trend that's been going on over the last few years. And we're seeing fewer and fewer bad actors, I would call them, companies that are sort of growing at any cost, especially in the US side. I think on the Canadian side, especially on the natural gas side, there have been some growth at any cost type producers into a very weak local market. But sort of in aggregate across the US, you've seen more and more of this sort of good capital allocator behavior, which has resulted in much slower growth. And actually, I think we're actually lower, even if you adjust out the weather-related issues for natural gas production, you're actually at lower gas production now than you were at a year ago. And it looks like when you adjust out some of the issues with EIA reporting and so on, we may be at similar levels of oil production right now to where we were a year ago, which is really significant. We were seeing pretty high single-digit production growth rates in shale, both for oil and natural gas, for many years. And so this is a very big change. And it's important to note that this has already happened on the natural gas side. And it looks likely that it's happened on the crude oil side as well.
And you and Christine Guerrero have been on the show a number of times over the last couple of years talking about how these wells in the Permian Basin, they're starting to skew way more towards natural gas for the amount of energy produced per barrel of oil that is drilled, the energy. So the percentage of natural gas versus oil coming out of each of the shale wells drilled is increasingly in favor of natural gas.
I'm not sure that that's 100% true, actually. I mean, there are some shale plays where that's happening, but if you look at the production for new wells in the Permian, you're still seeing really high oil percentages on new production. It's just that as you have those wells start to deplete, their oil production declines a lot faster than their natural gas production. So the mix gets more gassy as production growth slows, and then as you get into what looks like very small sort of overall production declines. But I don't know that, as we look at the new wells by individual operators and sort of have a ground up approach on that, I don't think we're seeing a big change in the sort of production mix on new wells. It's more that the basin's becoming more gassy as the new versus old mix is shifting. So I think it's evidence of a maturing field, but I don't think we're at the point yet where the new wells are way more gassy. I think that will be coming, but that's not what we've seen so far in the last couple of years.
So I get asked this question all the time about tier one acreage versus tier two. Has Bison Interest, have you done the research work showing maybe the difference in break even costs? Say a tier one wells of the past, some of the best low cost producers in the Permian Basin, were they breaking even at $45 a barrel? And then tier two, are we looking at $75, $80 a barrel then for costs once we transition then more towards only tier two acreage?
So I think this is something I got wrong a few years ago, and I think it's worth highlighting when you do the work on something and get it wrong to be able to, one, be honest and open about it, and two, if you can't admit when you're wrong, you can't hope to be right, and to learn from your mistakes. And so it looked like coming out of COVID that there was significant inventory depletion, and that the industry had really moved towards drilling less good wells, and that you would see much worse well productivity, and a variety of factors contributed between innovations like drilling these U-turn wells, or they call them horseshoe wells, where you can get a 2 mile lateral drilling on a 1 mile section by drilling to the edge of the lease line and then doing a U-turn and drilling all the way back and completing that. And those wells actually, I expected them not to work. They work fantastically well, and as well as drilling even longer straight laterals and completing them and going longer actually turns out to work pretty well too. You have pretty low degradation, at least on initial production rates. And so there hasn't been as much core degradation as I thought. We're still getting there, but it's taken a few years longer than I thought. But yeah, the one other factor on those break evens is natural gas price. And so as natural gas prices rise, and in our outlook, as we expect natural gas prices to go from maybe 250 an MCF where we were at a year ago to maybe 350 or $4 or more. I mean, Aethon and Expand, the old Chesapeake, are talking about needing $5 an MCF gas on the forward curve to actually justify incremental spending on gas, which is probably necessary to meet growing demand. But even if you underwrite to, let's say, $4, that really changes your break even versus 250. Again, even if you're 80% oil on your wells initially, you get down to 50% or so pretty fast over the first, let's say, 24 months, 18 months, something like that, depending on the well and the formation and so on. So that changes your break even a lot. A well that needed, let's say, $70 oil to get a 25% rate of return at 250 gas might need $60 oil to get that same sort of return at, let's say, 450 gas. So there's some flex there. I just thought I'd highlight that. But yeah, I think you're moving from very, very few wells remaining that generate a positive risk-adjusted return at $40 oil, And that's, I think, I mean, there's very few wells, despite what public companies claim and so on. Like there's not many wells left to drill at that sort of break even. I think core wells at this point would be sort of in that $50 break even with, let's say, 350 natural gas as an expectation, and then tier one wells, maybe you're moving to a $55 or $60 break even. And again, these are higher numbers than the public companies are showing in their presentations. But when you do the work on their financials and try to track what they spend versus what they actually make, I might actually be too optimistic on that. And it might actually be an even lower return or even higher required oil price for that. And then, yeah, as you get into tier two, even with the technology improvements and cost savings and so on, maybe you need something closer to $70 oil and sort of 350 gas or so to get to break evens. And so that's where you've seen the evidence of that, partly just in the falling rig count and the falling pressure pumping count, which is one way you would expect to be able to tell that that you're not hitting your rates of return that are required for capital deployment by observing a low price for oil and natural gas and falling activity levels.
Yeah, Christine Guerrero has said something similar. She's been saying for the last 12 months that the break even was around 60, 65. Now, there was lower cost producers with break evens below that, but she said the industry average for the higher cost ones, it was like 60, 65 in that trading range there, Josh, when the oil price was getting into the mid to low 60s. I mean, that was break even or losses for a lot of the producers. And that's why you see the rig count, like you said, why it was falling, because it didn't make economic sense to keep drilling wells if it was either right at the break even cost or below the break even cost.
Yeah, I mean, I think the break evens were probably a little lower than that. I think we're getting to that price point, let's say probably for this year, and then we may require even higher oil prices for next year. And then it's a really hard it's really hard to sort of simplify it to that, because you also have a low rig count. And so one of the benefits of having very few rigs running is you have the ability, if you're an operator that was running 3 rigs and now you're running 1, you can focus a much higher percent of the wells that you're drilling on your core inventory. Whereas if you had 3 rigs running, you might have run out of core inventory already if you were running them all on your core. And so you would have had to run them on tier 1 or tier 2 or so on. So there's been a high grading of the actual wells drilled. And so that, I think, has affected the realized returns, which have been higher than what the numbers you just described. But again, I think there's some dynamism to those numbers where when you flip it and you get to a higher rig count, which it looks like you need in order to sustain current oil and gas production, and then you especially need more rigs to be able to grow to meet the demand on the natural gas side this year and over the next few years. And so as you have that rig count expand, you're going to have diminishing efficiencies, and you're going to have an increasing number of wells drilled on tier 1 or tier 2 or even tier 3 inventory versus a very high percentage on core inventory previously. So those are the factors that make it a little more complicated and made, I think, drilling efficiency look better than it probably should, or than is a realistic sort of mid-cycle expectation, and drove returns higher temporarily. And I think the reality is for the industry that the returns on development are lower, and that you'll end up with a much higher break even. You just didn't experience it yet because you had so few rigs running, and you had so few rigs running because you had low prices. And so it's sort of this like weird sentiment and supply loop that's expressed via capital budgets and capital availability and oil and gas prices. And they say the cure for low prices is low prices. And I think we're starting to see that. And I think we might see that play out in a pretty significant way even this year, both on the oil and natural gas side here in the US.
And before I ask you about natural gas demand growth from electricity, the data centers, liquefied natural gas exports, and how I think the Trump administration could be pro liquefied natural gas and natural gas investment here in the United States. I want to get your thoughts on the mergers and acquisitions boom that's happened the last couple of years. Do you think that this will continue then? A lot of the stuff that you just outlined, it sounds like there's going to be more capital needed to maintain current oil production levels. Would you expect then the mergers and acquisition boom to keep on continuing, or do you think it's going to start to slow down?
Um, I think you need the share prices of the acquirers to do better before you see a lot more activity. When you look at some of the public companies that did some of the larger deals in the last few years, in some cases their stocks traded up, but in many cases they traded down, in some cases pretty significantly. And I think you need to see the equity market start rewarding those sorts of deals in order to see more of them. So I think there's just some, again, it's sort of this like price and sentiment sort of circular effect where the lower share prices are, the harder it is to do those sorts of deals, but also the harder it is to justify spending money on drilling or completing wells versus just paying down debt, buying back stock, and paying dividends. And so I think there is some circularity to that. But I think the drivers of those deals, the fundamental drivers are still there, which is inventory depletion and capitulation by private equity backers and exhaustion by management teams and exhaustion of inventory. And so as you sort of hit the wall on that sort of thing, you're gonna, if you run out of inventory, you go sell to a production buyer. If you prove up a bunch of inventory and you've drilled some of it, maybe you sell to a public company. If you're a public company with limited inventory, maybe you sell to another public company, and the accretion and dilution valuation considerations are very complicated and make those deals sometimes tough. But I think you'll see more of them. And then I think my favorite deal from last year was probably actually the Conoco Marathon deal, which and I have small exposure to that through related securities. So just as a full disclosure, but I'm not talking about it because I have that exposure. I'm talking about it because I really like the deal where Conoco bought Marathon because, as I understand it, and this was in their materials, so I believe them. Conoco had a buyback program and Marathon had a buyback program, and Marathon was buying a much higher percentage of their shares than Conoco was because they were at a lower valuation, probably partly because they had lower quality assets. So Conoco bought Marathon, reduced a bunch of the G&A on the Marathon assets, and now is in the process of starting to buy back even more stock than they were before. Conoco stock got hit, but that's actually beneficial to Conoco. I know this is going to sound weird, but it's good for them because they're buying back shares. So buying back shares at $100 a share is way better than buying back shares at $150 a share. You get for every 2 shares you would have bought, you get 3 shares. So it's a way better deal, a way better returns from those sorts of buybacks. So I think you're going to see more deals like that, where there's just some pure sort of financial math considerations on that sort of accretion. And then when you think about what that means from an industry supply perspective, a company that's engaging in that sort of transaction activity is clearly hyper focused on shareholder returns and very unfocused on any sort of volume or production growth for the sake of production growth. And some of the companies we've seen that have done that have actually allowed their aggregate production to fall a little because they're able to retire so many shares that their debt adjusted production per share is able to rise rapidly, even if their absolute production level falls a little. So anyway, sort of wonky nuances of a specific deal, but I think that sort of deal type, which was pretty significant. I think the Marathon market cap at the time, I'm forgetting the exact size, it was like 20 billion or something. So it's a pretty meaningful deal. I think you could see a number of other deals like that that are driven by financial considerations that sort of knock out potential production growth from mid caps that you would have expected to grow otherwise.
And you went into great detail, but it sounds like going to the gym, for New Year's resolution, since we're around that time, it sounds like people are focus on short-term pain, saying the share price, oh, the acquisition was bad, but you're talking about the long-term gains, outlining that over the next couple of years, ConocoPhillips shareholders, the overall company is going to be a lot more efficient. There's a lot of discounted, a lot of very cheap operating cash flow multiples out there. So but you said with the low share price, you said that the CEOs of a lot of these companies don't want to do deals with the low share price valuation, even though there's low operating cash flows to go and buy.
Yeah. I think it's complicated. I think it's way easier. Let's pick on Devon, which I don't have much exposure to. Or I also similarly have these like baskets and stuff, so it makes discussing any of these companies slightly complicated. But I have some exposure. I am biased. But if you look at Devon, they their stock got punished on their last couple of deals, and so I think if you're in their boardroom or you're their executives and you look at a next possible deal, you think, hey, maybe let's go digest the recent deals we announced and have closed on and so on. Maybe let's go pay off some debt. Maybe let's go buy back a bunch of our stock. And maybe instead of issuing shares at 30 or 35 on our next deal, we could go issue shares at 50 or something like that. And again, on public to public type mergers, it matters less because you could have two shares that are both depressed and have similar sort of accretion and synergies and so on as you would have had at higher prices. But on public to private type deals, I think you really need higher share prices to get some of those deals done.
So now I want to transition to natural gas, liquefied natural gas, investing in natural gas pipelines here in the United States. Do you think that there's more growth opportunities over the next 5 years or so in natural gas electricity demand growth because of data centers, because the European Union needs diversified liquefied natural gas supply away from Russia? So do you think then that natural gas potentially has more growth opportunities right now than oil?
Absolutely. I think you can see in the demand data over the last number of years that natural gas demand globally has grown much faster than oil. And I'm an oil bull, but it's sort of weird. I have this like high forecast of 1% global oil demand growth based on the last 40 years of roughly 1% a year oil demand growth. And somehow that's perceived as radical, but I just figure, hey, when you look at how these things work out on balance over time, that's been sort of the, even with efficiency gains, even with moves towards electric vehicles and so on, it's a number that the world seems to be able to get to, even with dire economic circumstances in China and various other places that were incremental consumers of oil. On the gas side, you've seen global natural gas demand rise at a much faster rate than that. And you may be seeing that actually pick up depending on the success of global electrification efforts, the success of getting electric power to more people in the world, and then getting them air conditioning and food refrigeration and other sort of basic standards that we have in Western countries that aren't available to too many people in the world. And so as that happens, you actually have significant upside to natural gas demand. And I think we're finally seeing some realism, maybe not by the IEA, but by a number of other groups and governments and so on, that natural gas is an important component of the likely future consumption mix. And while the mix may decline slightly potentially in the US and certain other developed countries as solar and wind growth continues, in aggregate globally, there's substantial room for natural gas demand growth, and so I think there's real room. Maybe you could end up with global consumption growth rates closer to 5% a year on the natural gas side versus 1% a year for oil, and maybe it ends up being 3%, maybe higher than 5. We'll see in terms of various trends that are in motion and how far they go and how much they accelerate versus decline. But I think that multiple percent growth a year for natural gas consumption is a really powerful tailwind for potential natural gas suppliers to that global market.
And the new part of the equation for natural gas demand growth, for electricity demand growth, and I think natural gas is going to play a large part of this, because you can't in the United States and a lot of other Western countries build a nuclear power plant very, very quickly. Maybe you can add like one of the cones into an existing nuclear power plant or restart some nuclear power plants. But in general, like that's still going to take years, and there's a large permitting process, billions of dollars of capital. Natural gas is just easier. It's easier and more efficient, especially if you have a Republican controlled Congress, especially if you have Trump in the White House, at least for the next, looks like 4 years. So I think natural gas, the one piece of the puzzle here, the demand for the demand growth, Josh, is these data centers, and these we have had data centers in the past, but the new data centers for artificial intelligence, we're talking about like an order of magnitude more electricity usage if they actually, the big technology companies, OpenAI, XAI, owned by Elon Musk, if they start to build these data centers at the levels of the Colossus data center that Elon Musk just built in Tennessee. I don't know if you saw, he negotiated like insanely fast construction build, 120 days to build this 100,000 GPU unit data center. He had to negotiate the natural gas pipelines. I think he got the largest amount of neon gas for the cooling system. He had to secure the largest supply of neon gas in the whole country for this data center. And now they're talking like the engineers at like Google and Microsoft, OpenAI, NVIDIA, like all the other experts that were in charge of building these data centers. They said what was done by Elon Musk at the Colossus one with that many GPUs, 100,000 plus GPUs there, they said it was impossible. But now the whole industry is scrambling to copy that data center design and start building them out just like that over the next couple of years. And that, to me, Josh, that looks like a lot more electricity and natural gas demand. Not immediately, not the next year or two, but like next 5, 7 years.
Yeah, I think it's definitely possible, but I think it's also possible that that ends up disappointing, and maybe that'll be the direction of data center build outs, and maybe there'll be many, many more of those built, or maybe that won't turn out to be the optimal approach, and maybe it'll be a slower growth. And I think it's possible to take a conservative approach forecasting. Um, towards forecasting demand for natural gas for data centers and still see a potential significant shortage or at least shortfall in current production growth uh, trajectories, and seeing too low of activity from a drilling perspective and too low of likely production from that. Just looking at the build out of liquefied natural gas plants and the build out of petrochemical facilities. And that's even before considering potential reindustrialization, redomiciling of different non-petrochemical industrial activities that an incoming President Trump has talked about and hoped for and has sort of on his policy docket. So, I think the data center demand could sort of exacerbate what may already be a pretty significant natural gas supply shortage, at least at current forward pricing levels. And then we'll see in terms of the data centers. So I think it was I've seen a few different estimates of something like 3 BCF a day of incremental demand for data centers by the end of this decade. So by, let's say, 2030. And so maybe it ends up being 5 or 8 BCF a day, or maybe it ends up being 2 BCF a day, but that's very small relative to 15 BCF a day or so of expected incremental liquefied natural gas capacity over the next 4 or 5 years.
So do you think then these liquefied natural gas projects, some of them have permits and some of them don't, are we going to see a Republican-controlled Congress and the Trump administration and the new Secretary of Energy, are they going to fast track these liquefied natural gas projects and the pipelines to the liquefied natural gas export facilities down there in Houston, Texas, and the Texas area in Louisiana?
Yeah, I mean, Trump has talked about doing everything he can to facilitate any investment of the amount. I think it was $10 billion, and these facilities typically cost more than that. So I would have expected them to support them already. But yeah, I think there will be a real effort to fast track them. And then there's 2 different facilities that have gone from FID, so the decision to go forward with building them, to actually having them complete and online in less than 3 years, which is amazing because these things used to take 5 to 10 years to build. And so both of the Plaquemines facility and Sabine. I can't remember if it's called 3 or C, but but one of the Sabine facilities. Both 3 years or less from final investment decision to first liquefaction of natural gas. And so that speed up, I think, is very poorly understood by the industry. And while it remains to be seen exactly how much money is saved by moving that quickly, it's impressive that it happened even in a period of post-COVID inflation and supply chain constraints and all of that. So it's impressive to actually just get that done in that time period that quickly. But it's also impressive to be able to navigate all the different regulatory stuff in the Biden administration, where they really tried to slow down or prevent things like this. I mean, they even slowed the permitting approval process and then some of the other regulatory around liquefied natural gas facilities and around pipelines. So these guys got this stuff done despite all of that in less than 3 years. I think this means that we end up with a bunch more LNG facilities online, let's say 5 years from now, than people are expecting. And I think one important consideration is that with global natural gas demand growth and with this period of very high LNG prices delivered in Europe and Asia, I see there being a lot of demand for natural gas delivered at, let's say, $10 an MCF versus the current 14, but delivered at that price, or maybe even a little lower than that, contracted firm for a number of years, maybe with a small inflation escalator. And so I think there's room to potentially grow the supply a lot. And I think a steady supply of natural gas, in addition to a slightly lower price, could be very beneficial in terms of securing substantial additional demand. I think there's some circularity to natural gas demand, and there's some relation between that and the price that it's available at, as well as the certainty of supply. And so I think when you consider all of that, there's a lot of upside to how much natural gas could get exported from the US and from North America. And again, when you get back to these issues of available inventory and concentration of inventory in relatively few companies, and those companies being for the most part focused on shareholder returns rather than on production growth at all costs, I think you have a really nice recipe for natural gas prices rising beyond the current forward curve price of sort of 350 an MCF, or looking further out, maybe closer to 4. I think there's upside to that even before inflation considerations.
Well, also because of the capital expenditure to build those liquefied natural gas export facilities and then the pipelines to get at the facility and the conversion facility, you don't want to be exposed to the spot market with fluctuating prices. So you want, like you said, you want a win-win deal where an electrical utility company in Europe or Japan comes in and buys an offtake agreement, and then the company building the liquefied natural gas export facility can still have a profit, but they get the upfront capital and they have a secured contract. So it's just a win-win scenario where they're not exposed to the spot market with rapidly fluctuating prices there. I think like you've seen this for many, many years, what with Cheniere Energy, where they've locked in a lot of supply deals. The newest one, what is Woodside Petroleum? They bought Tellurian, which had all the permits and then couldn't use debt for the financing. So Woodside Petroleum Australia is one of their largest oil and natural gas producers. They took over the project, and I think they already negotiated a very large offtake agreement with the largest electrical utility in Japan.
Yeah, and then I think you're also seeing from an upstream perspective. So it was really unfortunate what happened with Tellurian, because they had this integrated model where they were going to be producing gas, and they were trying to build this liquefaction facility, and they were going to try to contract it out to end consumers like utilities in Japan and elsewhere. And that didn't quite work, but you are seeing upstream producers starting to get interests in liquefaction facilities, or at the very least get marketing deals where they're able to sell their gas into the European market or into the Asian market via TTF or JKM type pricing and supply contracts. And so I think we're moving towards a world where there's a higher concentration of producers, and where an increasing portion of the local gas supply ends up being locked up for these liquefaction projects and then committed to delivery in China and Japan and Europe and various other places. Again, this is wonderful for energy security, but it's also very bullish for price. And I think the case study we're referencing is Australia, where you saw a similar dynamic and you saw the local market price go from very low levels in, let's say, the mid 2000s to a recent price that's much higher than that. And you've seen local price spikes in Australia where you have too much of the gas committed for liquefaction. And again, it's not that I think that gas will sustainably be at, let's say, $10 an MCF or anything like that here in the US before considering inflation. But I do see a lot of upside from this very low. I guess as we're talking, spot natural gas is getting closer to 4, but the forward curve has a number of months with natural gas in the low 3s. And so I think there's room for that floor to be higher and for the average price to be higher, and then to have fewer months, if any, where you have ultra low prices like we saw in 2024, where natural gas had moments below $2 an MCF.
Yeah, I think with the Republican controlled Congress and Trump in the White House and an energy secretary, a new one that seems pro investment into different types of energy. So oil, natural gas, nuclear power. I saw a brief presentation, 20 minutes or so, where he had slides saying we need to invest across the board in all forms of energy. We don't want to block any forms of energy. We want to allow all forms of energy to get investment and then let the free market decide which ones will produce free cash flow and positive return on investment. So I think that's a good overall policy. Unfortunately, over the years, Josh, there's just been, it seems like every administration that comes in Congress or the White House, they have a pet project and they're like, oh, we're going to back this type of electric vehicles. We're going to waste government funds or subsidies on that. Oh, we're going to do biofuels. Oh, we're going to do solar wind. We're going to throw subsidies or money at this type of energy. And then it's not an across the board approach. I think that's smarter.
Yeah, I agree. I'm a big Chris Wright fan, and I think based on the people who are being selected for the incoming administration on the senior level, as well as one level below that, it looks very promising. And I'm very optimistic about positive change and a positive trajectory. I guess I'll just butt in and say the one form of energy that I'm not so excited about is this whole wood fiber thing, where you have North American forests cut down and turned into pellets. And I'm a big barbecue fan. I like to use a wood pellet for smoking meat, but I think the appropriate use for wood pellets is smoking meat and not burning them to generate electricity. It's a very dirty way to generate power. And even though it's technically renewable, there's significant subsidies for this sort of power generation in Europe, and I think to a lesser extent in the US and Canada. And, I'm a most forms of energy advocate, but I think that one should stick with barbecues and not be in the power generation mix. And I think would never have been in the mix if it weren't for subsidies and CO2 credits and all kinds of other things that have sort of smoothed the way for a form of power generation that probably never made economic or environmental sense.
Same thing for corn ethanol. I mean, the George W. Bush administration and Dick Cheney, they tried to do that for a subsidy to the Iowa farmers to buy votes.
Yeah. I mean, corn-based ethanol, it's just bad trade policy. Like sugar-based ethanol is actually not a bad idea, and it sort of makes sense. Corn-based ethanol, it's just not a great plan, and it's a real waste, right? You end up with this whole chain of overuse of fertilizer and then wasting really productive farmland that could be used for many other things that we actually need more of, and that's higher value, but it's hard to compete with enormous government subsidies and price guarantees and all kinds of other intervention. It's part of why it's such a mistake, I think, to have that sort of government intervention, is you end up with waste and you end up with misallocation of scarce, very valuable resources. And so, yeah, I think corn ethanol in the U.S. probably isn't the best plan. Some of this biodiesel stuff that they're doing and supposed so-called sustainable aviation fuel also. I mean, cutting into the food supply to try to generate energy for the most part, is not the best plan. It's super inefficient from an energy return on energy investment, which Chris Wright and others have written about and talked about a lot publicly. And I guess I've talked about a little on Twitter and various other places. And so, I think there is room for a lot of things. I think there's great use cases for solar and wind and nuclear and various other things. And then there's a real place still for oil and for natural gas and natural gas liquids. There's a place for coal. Coal is still extremely important for steel and other uses in addition to power. And so, yeah, I think it's great to have this sort of broad energy sort of umbrella, and then maybe to get the government out of it to some extent, to cut these subsidies and cut regulations and allow the market to win at the same time as, maybe making sure that there aren't sort of unfiltered coal power plants right next to large population centers, or similar like nuclear power plants in the middle of cities, or these biomass burning plants pretty much anywhere, just because of the pollution and the negative effect on the planet and on sort of quality of human life.
It's also my understanding that corn ethanol also ruins an internal combustion engine over time if it's in a large percentage of gasoline. So the engine runs well on hydrocarbons. When you start mixing in 10% or more of corn ethanol, an internal combustion engine does not run well and starts to break down faster.
Yeah, and that's the sort of calculation and the sort of observation that I think is really important in the energy conversation and in the energy policy conversation. And I think it's why it's so important to allow market forces to dominate rather than having government intervention. Because you look at like the duration of the durability of normal cars and trucks right now, and they might look like they last a certain amount of time and have a certain emissions profile. But if you were able to supply them with optimal fuel, maybe they would actually last considerably longer. And every year you can have a car or truck still on the road is a huge contributor to the environmental impact. So you dramatically reduce the environmental impact of a car if you have it operate for 13 years instead of 12, or 15 years instead of 14. And it's this fallacy that people have where they say, oh, I'm going to go buy a more fuel efficient X, Y, or Z thing, car, refrigerator, air conditioner, when in reality, it's actually sort of better for the overall energy intensity and emissions intensity and all these other factors if you just use the thing that you're supposed to treat it the right way and then be able to use it a little longer. And so again, Chris Wright is a outspoken advocate of this sort of approach. And I'm optimistic that that gets implemented here in the US. We're seeing rational policies start to get implemented in Argentina, which is very promising. And I know there's a good relationship between Trump and Milei. We're seeing some moves towards these sorts of rational policies in various other places. The front runners in Germany and Canada and various other countries seem to be also sort of on this same page. And so who knows, maybe over the next few years, we'll see a return to energy rationality, which could be a lead up to higher but less volatile oil and natural gas prices, and maybe higher profits and less boom bust dynamics in the oil and gas space.
So last question here, Josh, before I let you go. Do you think then for the Trump trade and Republican controlled Congress, do you think that natural gas for liquefied natural gas exports, petrochemical companies, natural gas pipelines, maybe either to the LNG export facilities or to data centers, do you think that those are going to be potentially good growth prospects, good cash flow, good promising trades to invest in over the next couple of years?
Well, I think there's this trap, which is that there is a set of companies that are doing really well because there have been all of these regulatory barriers to competition. So I think that's true for pipeline companies. It's true for LNG export facilities. It's true for certain petrochemical type facilities. And so as barriers to entry are reduced through reduction of regulatory burden and facilitating permits, I think you end up with more of those things built and maybe lower profits for incumbent providers, but adequate profits for incremental providers. And so I'm not sure. It's sort of like the shale boom all over again, except for the infrastructure companies and the LNG export companies and so on, which would be sort of a race towards marginal economics rather than overall profits. And so I'm actually trying to stay away from the infrastructure side of things where valuations are high. And I think appreciation of those sort of potential competitive factors is low. And I'm most interested in the companies where the perceived competitiveness is very high, but the move is very much away from growth at any cost towards optimizing shareholder returns and optimizing profits. So I'm most interested in smaller cap producers, which trade at a discount, particularly ones that are mixed oil and gas, where they haven't benefited as much from people looking to win from higher natural gas prices and higher natural gas consumption, and that don't win from people being very bullish on oil. So there's this whole set of companies that have sort of fallen through on the producer side. And similar on the oil field services side, there's a set of these companies that have sort of fallen through. Either their stocks are too small, their businesses are too small, or they're sort of offering a hybrid set of services, or it's not well understood where they actually provide those services or how differentiated they are. And so there's a set of companies that I think may be really disproportionate winners here as regulatory change happens in the US and then potentially in Canada as well, that are actually weirdly trading at very low valuations right now, even though I think they're most likely to be the biggest winners out of these changes. Whereas I think the companies that people think will be the biggest winners are actually the ones where there may be the most growth in competition and growth in supply of the various services that they provide. And so, again, I think the initial move on this is just sort of exuberance and revaluation of these companies that'll be able to do more activity, but more activity often actually leads to lower profits, not higher profits.
Superb, extra in-depth analysis from one of the top oil and natural gas hedge fund managers on the planet, Josh Young. Let me just add, though, too, if the market, and I don't think anyone, and I've looked at different estimates across the board, I don't think anyone has it figured out how much electricity demand growth is going to be from these data centers. So if the market is really low on the estimates, if they're off, and say 5 to 10 years from now, they built these giant data centers out, I mean, there's going to be huge demand growth, huge profit potential across the board for a lot of these natural gas and infrastructure plays. So we'll just have to see. It's too early to tell, I think.
Yeah, for sure. I think if there's upside to the demand side, some of these infrastructure companies and projects that I'm avoiding from an equity investment perspective could actually do quite well as well. So I'm not saying they won't work, but in that sort of case, some of the drilling rig providers and pressure pumping providers, some of these smaller producers that have very large land bases and large resource in place, but maybe have higher break evens or higher cost of capital, so they can't address some of those resources. I think those companies, especially trading at very, very low valuations versus replacement cost and current cash flow and reserves and other sort of real value metrics, I think some of those will do even better in the scenario you're describing. I'm just trying to be pretty conservative on it. And if you just look at the base scenarios for data center demand growth for natural gas, and then for approved in-process LNG facilities, there's a gap between the current supply growth trajectory for natural gas and these things that are already in place. So we don't have to be real aggressive on this sort of shorter cycle to build LNG facilities. We don't need to be aggressive on the data center demand. All of that is just pure upside. And I still think you end up needing pretty high prices just to meet that sort of conservative base case for natural gas demand. So that's what has me really moving over from, I think the last time we spoke, I may have been a lot less bullish on natural gas. And I don't like that the spot price has moved up as quickly as it has. And who knows what happens with the weather in the next day or week or month. But over the next year or two or three, I think we may see much higher natural gas prices and much higher lows for natural gas prices.
Please talk to my listener. Please tell my listeners about the Bison Interest email list with your white papers on your research, and then about your publicly traded hedge fund.
Sure. Yeah. So none of this is an offer or solicitation or recommendation. I run a investment firm focused on publicly traded oil and gas companies. That's only open to accredited investors. So this isn't a solicitation for that. We do provide free research via our website, bisoninterest.com. If you're interested, would like to sort of read what we're up to and get an update on oil and gas markets on a pretty regular basis, you can find us on bisoninterest.com. Jason, thank you so much for having me. I really appreciate this.
And definitely check out Josh's his side handle there. Would you have a lot of barbecue and grilling tips out there too?
That's true. I need to run. Thank you so much. Take care.